February 24th, 2025, will be remembered as a day of significant losses for the Indian financial markets. Both the benchmark indices, the BSE Sensex and Nifty 50, tumbled to their lowest points in 8 months. This decline was fueled by a potent combination of domestic and global factors. The US Federal Reserve's recent signals on interest rate hikes have sparked a wave of risk aversion among foreign investors, leading to a mass exodus from emerging markets like India. Domestically, concerns about slowing economic growth and rising inflation have further dampened investor sentiment. The rupee too felt the heat, weakening against the US dollar. However, the Reserve Bank of India, or RBI, stepped in to curb its fall by injecting liquidity into the forex market. The only silver lining in this otherwise gloomy scenario was the performance of gold. The yellow metal, often seen as a safe haven asset, rallied on the back of a weaker dollar. This surge in gold prices provided some respite to investors seeking refuge from the volatile equity markets. The equity market witnessed a bloodbath, with the BSE Sensex plummeting by a staggering 857 points to close at 74,454.41. The Nifty 50 too mirrored this downward spiral, shedding 243 points to end the day at 22,552.50. This freefall was primarily triggered by fears of an impending recession in the US, the world's largest economy. The US Federal Reserve's hawkish stance on interest rates has raised concerns about a slowdown in the US economy, which has sent ripples across global markets, including India. Adding fuel to the fire was the massive sell-off by foreign institutional investors, or FIIs. FIIs have been on a selling spree in the Indian market for the past few weeks, spooked by rising global interest rates and the strengthening US dollar. This exodus of foreign capital has further weighed down the Indian rupee. Among the worst hit stocks were heavyweights such as Reliance Industries Limited, which slumped by 1.05%, and NTPC Limited, which tumbled by 1.79%. The IT and financial sectors, which are heavily reliant on foreign investments, bore the brunt of the sell-off. In stark contrast to the equity markets, gold emerged as the only winner on February 24, 2025. The price of 24-carat gold surged by 100 rupees to reach 87,870 rupees per 10 grams. This rally was driven by a confluence of factors, the most prominent being the weakening US dollar. Disappointing US macroeconomic data released earlier this week cast doubts over the strength of the US economic recovery, leading to a sell-off in the US dollar. A weaker dollar makes gold, priced in US dollars, more affordable for buyers in other currencies, thus boosting demand. Furthermore, the current global uncertainty and inflationary pressures have added to gold's appeal as a safe haven asset. Investors tend to flock to gold during times of economic and geopolitical turmoil, as it is seen as a store of value and a hedge against inflation. The Indian rupee, already under pressure from the relentless selling by FIIs, weakened further against the US dollar. However, the Reserve Bank of India, or RBI, swiftly intervened in the forex market to arrest the rupee's fall. The central bank conducted a $10 billion forex swap, which involved simultaneously buying US dollars and selling rupees in the spot market and vice versa in the forward market. This move by the RBI is aimed at infusing liquidity into the forex market and curbing the volatility in the rupee. The forex swap is expected to reduce the pressure on the rupee in the near term.